Let's talk today about bubbles. There's speculation out in the marketplace right now and questions being asked as to whether the U.S. stock market is currently trading in bubble territory, in other words, in a high valuation range, an unsustainable high valuation level. The Federal Reserve, over the last number of months, with their quantitative easing activities, has added to the question of valuation. The S&P 500 right now is selling at about 17.5 times earnings. And if you look back in history, that number is a little higher than average, but it's not near bubble territory as we saw, for example, back in the late 1990s. The same can't be said about the Russell 2000 index. The Russell 2000 index is akin to the Standard & Poor's 500 index, and the Russell 2000 measures small cap companies, those 2,000 companies that aren't near the size and maturity as the S&P 500 companies. Now, the Russell 2000 index is currently selling at a little bit more than 28 times earnings, as compared to the S&P 500 at 16 times earnings. And a 28 times earnings ratio, PE ratio if you will, is high. It's fairly extended in relation to historical norms. And you go back over the last 10-year period of time, it's rare to find the Russell 2000 index selling significantly higher than 28 times earnings. The same can be said about price to book value, price to cash flow, and price to sales. Russell 2000 index seems to be a little extended at this time and approaching bubble territory. So as an investor, if you're looking at the idea of reducing your equity exposure in general right now, feeling that the markets are up pretty strong so far over the last 12 months, and take a few chips off the table, then it probably makes some sense to think about the idea of reducing exposure to small cap companies in this environment.